Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Patrick Justice. And as usual, today we'll go through the latest economic numbers for the month of June, review how our portfolios performed during the month, and then basically talk about some of the major topics that have been, happening and what our thoughts are moving forward. So today I'm going to have Patrick kick it off with some economic numbers. Patrick?
Appreciate it, Kelly. Thanks. Happy to be here. Big shoes to fill with Cam being out, but I'll try my best. Well, I think the biggest news of the month was the Fed raising rates by 75 basis points. We expected that coming. We thought 50, maybe 75, but mid-June they did make that move by 75 bips. With 4 meetings left this year, they're projecting by the end of the year we got to get to 3.4 for the Fed funds rate. So, that 75, we have to think there's probably at least another 50, if not 75, coming end of the month. They're even saying by the end of next year we might be at 3.8 for their median projection. So certainly something we have to be aware of. They're trying to certainly curb inflation at this point.
Oh, absolutely. I think we have to expect more Fed hikes coming up. Some bond strategists are thinking that as the economy is slowed, which Patrick will talk about some of the economic numbers, that the Fed will actually reverse course and start reducing interest rates. With inflation at its elevated levels, I don't see them doing that. So we're definitely getting into a situation with higher inflation and lower growth. So why don't you jump into that a little bit?
Yeah, so, official numbers for the first quarter now from GDP, negative 1.6 annualized as a result of those first quarter numbers. Now, even in the last couple weeks, Atlanta's Fed GDP now is now saying the second quarter is a negative 2.1 as well. Obviously, rule of thumb, 2 negative quarters like that, a lot of people say that puts us into a recession. Certainly an interesting economy right now with low unemployment. Some could even say maybe a stagflation sort of environment. So certainly something we have to be aware of with the markets in general.
And that's basically what I just alluded to. After the first quarter was negative, a lot of strategists thought, okay, second quarter is going to be positive, or, in the last couple of weeks, 0 plus or minus. Obviously, we've fallen on that minus side. Probably a little deeper than a lot of people are expecting if we're already in that, that minus 2% range.
Right.
And stagflation is a term that's used where you have high inflation, low growth. So the economy's stagnant, but you have inflation, stagflation. So right now, based on these numbers, we are in a recession, or we've been in a recession for the last 2 months. Probably not a lot changing, where recessions aren't just 2 months; they can last 2 quarters. I'm sorry, 2 quarters. The reality is obviously we could be in a multi-quarter recession that has already started. So that's kind of where we're at right now. The one thing that's different typically in a recession, obviously, the definition of a recession based just on GDP growth. We're just looking at GDP growth. There's other measurements or other definitions of recession that start factoring in unemployment levels, productivity levels. And that's what I think has thrown a lot of people off, is that unemployment is still not bad.
Low.
What's
That's
the latest
low.
number? 3 point?
Yeah, so we're sitting at 3.6 right now. We don't have official numbers for June at this point, but they're saying ballpark Kiplinger is reporting we've added about 300,000 in June. So that puts us right at the same number, leaves us at 3.6. So it's a very strange market, very strange economy right now to still have that low unemployment.
Unemployment's kind of steady.
Right.
There's still reports of more job openings than available workers.
Right.
But in the last couple of weeks, we've also started to see some layoffs in the tech arena. So different tech businesses, especially in the crypto world, but also in the tech world, more on the social media side, we're starting to see some job cuts.
They're preparing for it.
Stopping, hiring has been halted at a lot of companies in that technology world. We haven't really seen that trickle through to the other industries, or I haven't seen it. I haven't heard clients talking about. It's still a situation where you can't find enough workers, especially in the service arenas. We're seeing it with the airlines. Obviously, that's an employment issue where a lot of delays, a lot of cancellations because of lack of workers. So, a lot of misallocation of resources right now in the economy.
Big time. Well, another thing I wanted to bring up as well, as a result of these rate hikes, mortgages are tough right now as well. We've been talking to clients. I've been having conversations the last few weeks where, we were talking mid threes, low fours for mortgages. Now, excellent credit, low debt to income, all those factors, we're talking mid fives, maybe even into the sixes. That's a much different world right now. It changes monthly payments, changes a lot of decisions about housing, and that's a major thing that happens in this economy. It's something to be aware of.
Oh, absolutely. And there's kind of two things going on where now rates go up, higher payments. We've seen over the last 24 months where housing prices have definitely escalated quickly, especially existing home sales. And now, we're starting to see some pressure on those prices. So you're seeing existing home prices come down. I'm just seeing it anecdotally with clients trying to sell or buying houses. All of a sudden, they're able to buy more house than what they were able to 2 months ago. That's starting to happen. But the other reality in the housing world is demographically, there still is a housing shortage.
For sure.
So you're seeing existing home prices come down. In the builders world, the companies that are building new homes, their story is maybe a little bit different because they have more flexibility as to pricing and the quality of houses they're building. So they have more levers to move, where I think your home builders are going to do fine. One is they're not overextended like they were in 08, 09.
For sure.
But they're also getting, I think, caught up a little bit in just this concern around the housing arena. I definitely do not think we're in any sort of a housing crisis like in 08, 09.
Agreed.
It's just, prices probably got way ahead of themselves. We're seeing a retreat. I don't think it's going to be a crash. And now the buyers have to be a little more selective in what they're buying. And the reality is no longer the real cheap mortgages, 5-6% range. For most people watching this, 5%, 6%, 7% mortgage, that's a reality. Most of us have had those before. Life goes on. Those aren't overly oppressive rates, just they're not the 2-3% that everybody was able to refinance into. And hey, if you had that that 2.75% mortgage, 3% mortgage, there's no reason to refi right now.
Right.
And unless you have to move, well, you're pretty much
sit tight.
Probably sit tight. That's for sure.
Well, I mean, look, we came out of unprecedented low interest environment. I mean, the long-term 10-year Treasury is about 4.27.
Right.
So that hovers around 3 right now. We need to be realistic about that 5-6 range and just face the fact that that's a bit of the new normal, and it's a bit back to long-term averages.
And there's options with mortgages. I mean, that's the other reality. Because rates have been so low, you might as well go with a 30-year or 15-year in that 2-3% range. Now, thinking about 5-year ARMs, adjustable rate mortgages, 7-year ARMs, all of a sudden these are different things you might want to think about in purchasing a house. Can we get in the 4s or low 5s by doing a 7-year ARM? And once again, these are things that obviously we can help talk clients through as to what's that difference. Pay less interest, knowing that 7 years from now your rate could adjust. How does that factor in the equation? Those are things that are going to come back, I think, become more conversations versus, hey, just lock in at 30 years at
those were easy decisions for
those
a while.
Those are easy, and all of a sudden things are going to get a little more complicated. I wouldn't say harder, but just a little more thought's going to be involved in coming to the right conclusions there. Let's jump into how the market's performed and kind of our thoughts moving forward, things that we're thinking about. So June. May was kind of a flat month. It started bad and things got better, and we ended May flat. June, not a good month at all, and pretty much one of the worst months in recent years. The Dow in June was down 7%. The S&P 500 was down 8.2%. The Nasdaq was down 9%. the Russell down 9.4. On the international front, the MSCI EAFE, which is the developed world, down 10.4%. So that's just the month of June, a pretty brutal month. That was even worse than the worst month through COVID, I think, because COVID started kind of in the middle of one month, so that wasn't really spread over the period of a true calendar month. Year to date, that takes the Dow down 15.3%. Not its worst levels. I mean, we were close to down 20%. At a point was it in May or June? When we saw in June we saw the lows of the Dow. It did cross down 20 market at some point. The S&P 500 at the end of the month was down 18.8%. Once again, that got as low as about 24%. The NASDAQ year to date is now down 29.5%, so almost down 30%. The Russell 2000, which is small caps, down 24%. Once again, the international markets down 21. Emerging markets year to date are down 24. So, relatively speaking, the Dow and S&P are still the winners, but they're still, the S&P almost down 20%, the Dow down 15. That's still, not good year to date. Our portfolios. In June, besides the stock market going down, in June what we did see was a little bit of a retreat in commodity prices. So as I think the recessionary fears, a slowdown in global activity, because it's not just the U.S. that is showing poor GDP numbers. The world,
everybody.
We're looking like the cleanest shirt in the dirty laundry right now. But the rest of the world is definitely seeing contractions. Part of it being obviously the war in Europe, but we're not the only ones in this situation. And relative standpoint, we still look better than everybody else. So in addition to stocks going down, we had some pullback in commodity prices. Growth with Income Fund did underperform this month. In June, we were down 7.5%. Year to date, we're down 12.53. Like I said, commodities hurt us a little bit there. They didn't help us, that's for sure. Big gainers are one more stable value or stable asset holding, SPC, up 0.15, and PepsiCo eked out a 0.04% gain. Those are only gainers in that portfolio for the month. Pretty rough. One of our big hits in there from the downside for the month, Nucor down 20%, Microchip Technologies down 20%, NVIDIA, which fortunately we sold a lot of that early in the year, down 18%. Disney still feeling pain, down 14%. Year to date, our big winners so far, Exxon up 40%. Our commodities position up 15%. Those are basically what's been carrying the portfolio year to date. Year to date laggers, NVIDIA, down 48%. Disney taking a big hit, down 39%. Nike down 38%. Starbucks down 34%. So pretty rough month there, but we do have a lot of liquidity in that portfolio. Just kind of, you had both stocks and commodities going down at once. In dividend yield, which has been our strongest performer, in June, down 7%, kind of in line with the Dow, but still better than the S&P. Year to date, dividend stocks have held up really well. And this is really a story of, being invested in companies that are returning capital, paying dividends, solid balance sheets. They just keep on chugging along. You put your money in, you're getting money back because they are making money, and they're actually giving that back to shareholders. And shareholders can be paid back either through dividends or when companies take their earnings, reinvest them back into the company, but they have earnings. And you can also call share buybacks a return of capital because now as the owner of the company, your proportional share of the company is greater. So that's what you think about is return of capital, and that's really important in this environment. When
defensive,
it's defensive. That's what's going to continue to work. No matter what even though the prices go down, the companies are still producing, still doing something with that capital.
Those names aren't going anywhere. Those are solid companies.
In June, in dividend yield, even though it's good for the year, basically we had two flat holdings, Coke and UPS, they remain flat. Everything else is down slightly. Blackstone during June down 22%. Once again, that's not our story, but Blackstone has been very good to us over the years we've held it.
Yep.
We really chopped back the exposure there because it was getting to be a heavy overweight in the portfolio. We cut the exposure down significantly back in January and February, so that didn't do as much damage as it would have done when it was a big overweight. So we kind of stemmed the tide there, and we've taken a lot of gains off the table. Lyondell Basel down 18.9. That was making a nice little run. Caterpillar down 17. Those are a little bit more on growth, kind of a growth scare. Year to date, our big gainers: Merck up 21, British Tobacco up 16.5, Edison up 13, Southern Company up 6, Lyondell still up 1%. So once again, you're kind of steady companies, drugs, tobacco, utilities, still making money. Year to date laggards, Blackstone's given back 27%, Eaton Intel down 26%. Price potential, more of our growth-oriented portfolio, June only down 6%. So because of our rotation within there, always looking for better quality companies that have shorter-term growth prospects or price appreciation prospects. Like I said, down 6% for the month. Year to date, still down 13. So, a little better than the Dow, a lot better than the S&P. Our big gainer, Humana, once again, healthcare did well in June, up 3%. Big laggards, Facebook or Meta still, feeling some pain, down 13%. Pricing out looks good. Stryker down 14.9%. FleetCor Technologies down 15%. Comcast down 11%. Year to date, Humana is our big winner, up 1.26%. But that's what's still held in the portfolio. We've sold off some winners along the way, so that's maybe a little false sense there. Year to date, our big losers: Meta, that's been painful. T. Rowe Price down 40, and the International Continental Exchange down 31. Small caps, for as volatile as they are, June only down 8.5%, which I'll take away as a win. Year to date down 24, kind of in line with that whole market. Here's where you get the crazy numbers. In June, Kezar Life Sciences up 63%. Excel Services up 3%. Unitil up 1.57%. So obviously Kezar takes the prize there. Laggards though: Ryerson down 29%. CyberOptics down 22%. Variant down 17%. Year to date, our big gainer: Sierra Oncology, which we're selling this week, up 158%. So we're booking a nice gain there. Lantheus up 128% year to date. Unitil still up just under 30%. Big laggers: ATS Automation down 31%, Stewart IT down 37%, Clearfield down 26%. So, it was a tough month. I think our portfolio's held up well.
Absolutely.
But once again, it comes back to the fact that, we're looking at company by company. What are the companies that can, return capital to us, that continue to make money, even though prices are suppressed? Our capital's there working for us. And unfortunately, when the news of, or when the GDP numbers, the official GDP numbers come out, we're probably going to see some more downside to the markets. The S&P at its low point, I think, was down 25% from its highs. We could still have another 10-15% to the downside on the S&P from its highs, where we could see an S&P at some point being down 30, 35, 40% from its highs. That's probably in the cards. If we hit that point, when we hit that point, I don't think those low numbers will hold very long. I think that would be seen more as a capitulation type low. We're around. This is where we started at the high point. We're down here. You're gonna get lower. Off that bounce, you're gonna get up where it'll bounce off that level. We're not going to bounce right back to those highs again. One is because the nature of the indexes has changed, or the big drivers of the indexes are the stocks that are feeling the
overweight.
They're feeling the most punishment. I feel like we're in the area that wasn't super overvalued. We'll be able to come out of it pretty well. It's just going to be a waiting period.
I mean, and it's a testament to, look, we need to be defensive at this moment. Cash is certainly king at times like this. It's another good we're not timers of the market. We don't know exactly when that bottom or when that low point is going to be. But if we stay consistent, continue to dollar cost average if the situation is right, and just keep adding money when times look bad, that's a way to be successful in the long term.
Yeah, I mean, we're looking for companies that are going to survive it. But once again, you have the big picture, what the indexes are doing, what the markets in general are doing, but it's really our job to bring it down to the client level as to making sure the client's going to be able to, or our clients are going to be able to get to where they're trying to go, fund their retirements, maintain their lifestyles, and that's a different metric than just pure performance. It's about having that money there for when we need it now, money in cash, short-term investments like SPC or crossing bridge, low duration. Those are good holdings, or even now we're starting to layer in treasury bills because the rates aren't looking too bad. I mean, we can go out 12 months and get 2.8%. We can go out 6-8 months and get over 2%. So okay, we can park money there. It's going to be there when we need it. Eventually the market, our positions will bottom out and we'll start being on the plus side. By the time that happens, we will still have extra cash collateral available, but we're not going to be forced to sell low, and that's one of those things where things are getting a little tenuous right now from a market standpoint. A lot of bad news is getting out there, which is what you need to have happen for the bottoming process to happen.
Absolutely, it's natural, right?
It is natural. So that's kind of where we're at right now. Patrick, first time on here, and Patrick's been with us, 3-4 years now?
Feels like that. Almost 2 at this point.
Okay, so 2 years. Has a little different look on things, and he deals with a lot of our clients. What kind of things are coming up in their minds, or what kind of questions are you getting these days?
Yeah, I mean, there's certainly some macro topics, things that we discussed as far as GDP and inflation and big picture items as far as should people be concerned. Do I have capital? Can I still meet my goals? And you nailed it. These conversations as far as, can I take my monthly distribution for retirement? Should I move? What mortgage rate should I lock in? All of those are very common topics, and I tell people this all the time. If something's on your mind, please give us a call. That's what we're here for. We're advisors. We want to walk you through this, help you through these sorts of decisions and fears you might have in the market. And we're confident where we're at. We like where we're positioned. And if you feel like you need another look, that's what we're here for. Pick up the phone and give us a buzz. So,
I think one thing you asked me on earlier, prior to the video was, what am I looking at right now from an economic standpoint? What am I focusing on? And the biggest dynamic that we're looking at right now is you have high inflation, low interest rates. So Patrick threw out the 10-year Treasury bond. So put your money in a 10-year Treasury bond right now. If you're to buy one today, you'd be getting something just less than 10%. So that's less than 3%. That's 10-year, 3. Yeah. Or even now use a 2-year. You're just under 2.8% on a 2-year. So if inflation's running at 8% and you're only getting 2.8, you're only getting 3% on your interest. Well, if inflation's 3% interest, your real interest rate, which is your interest rate adjusted for inflation, is -5%.
Correct, real return.
That's a problem. And when we're in that type of environment, that's not going to be good for stocks. It's not good for bonds. And that's what's happening right now. So what we need to have happen is we need real interest rates, or close to real interest rates, which means, okay, if inflation comes down, rates go up. When we get to that point where they're a lot closer, that's more of a sign that, okay, we're pretty much through this cycle and, getting back to, more reality, so to speak. Being in low interest or no interest rate world creates a lot of distortions. And, now we've had such a long period, 10 years, or really
12
to 13 years, going back to 08, 09, of very low interest rates. You get a big misallocation of capital. I think we're going into a period where the Fed is going to raise rates as much as they have to get us to more average rates. Patrick threw out there the average interest rate on the 10-year Treasury is 4.9%.
4.27. Yeah,
and
long term.
Historically, I mean, that's with 10 years of really low rates.
Right.
Historically, in my mind, it's always been 5% plus.
Right.
And so, if we end up coming out of this with 5% on the 10-year Treasury, okay, that's not excessive. It's not like 20% back in 1980.
Right. It would feel like it in the short term.
Yeah, it would feel like it. But also, as a business, if you can't operate your business with rates in the low, high single digits, 5 to 8%, you should be rethinking how you're running your business.
Correct.
That's what we have to look at, is companies that can sustain and can handle higher interest rates. And we're not talking about 20% interest rates. We're talking about more normalized rates.
Reasonable long-term rates.
And that's where we're going, where I believe we're going to go. And I think the Fed's going to get us to that point before they reverse course. And the pain we're starting to feel right now is where it's happening. But the pain isn't, completely across there's a lot of healthy companies out there. It's companies that have higher debt loads, have built their businesses on zero interest rates. That's a problem. So those are the businesses we're trying to weed out of the portfolios, or we're not going to get involved in them at this point in time. So that's the kind of dynamics we're in. I think we have more rough sailing ahead of us. We got a little bit of a reprieve the last week or so, but the volatility is still out there. At some point, the market will bottom, or we'll see the end of this. And the one reality is the market will bottom before the economic numbers get better.
For sure.
And that's something I always remind clients is you can't wait till, hey, the recession's over. Now the market's going to turn around. The market's going to turn around before that happens.
Naturally.
So if we're already in, 2 quarters into a recession now, could we see another couple quarters of negative GDP numbers? I think that's very possible.
Well, you keep bumping rates up like that. I mean, the other thing too, unemployment still sits very stable, as we said right now. I have to think that that's going to be affected as well as we continue to affect rates and affect the economy. You would think.
I would agree. I would agree that it's probably going to be coming at some point. But with that excess, more jobs than workers, obviously the inventory jobs should fall. So once again, that dynamic may happen too, where your number of jobs available and workers starts to even out, and we start to see a little bit of an increase in unemployment, or this becomes the recession where unemployment was below normal.
Sub 4 the whole time?
Yeah, that'd be crazy, but it could obviously happen. But the market's moving fast. There's not as much liquidity in the market, so that means bigger swings on a daily basis, on a weekly basis. To see lows sooner than later, I think is starting to become more. My mindset is this could happen quicker, and before the year's out, I would guess we're probably going to see the low and already see a market reversing course. If the Fed stays steady with raising rates. If they reverse course, that's probably my most unclear prospect. If the Fed starts reducing rates, what does that really do? Does it just inject a sugar high? I can see inflation, getting ramped up again. It's going to be interesting. I think they're going to hold steady.
I think they're going to have to. I mean, they've been
at least for the next several months. They're
going to have to. They've been preparing. They try to keep the markets and people and the economy prepared for those rate bumps. I think they've done a good job at that, and they've hinted at that 50 to 75, and like I said, that 3.4 target by the end of the year. I just can't see them reversing course with the track record of inflation. I think they have to try to, nip it in the bud.
And if you didn't see this coming, as a asset manager, portfolio manager, you're feeling some pain, but you knew it was coming at some point. You just have to be, once again, kind of our approach, be in the survivors, keep things simple. Don't be way out in your bond holdings, which we are not. Have some, inflation hedge in there with the commodities, which, they're not perfect. They don't always work, but I think they'll still help us as we move down.
You want real assets at this point,
exactly,
for sure.
So that's all we have today. It was a rough month. Keep the seatbelts buckled. Great 4th of July weekend. Enjoy your summer. If you have questions or want to discuss your accounts, what you have coming up from an expense standpoint, or want to reassess where you're at, obviously we're always available. Please reach out.
Absolutely. Take care. Thank you.
Thanks, and have a great day.